Hey, YouTube is just giving me the new features. I could put people in timeout if someone's not acting right. You know, my mom's and my grandma used to say, need to make sure you have some act right. Get your act together. So if your act ain't together, you get put in timeout. Used to be worse than that when I was a kid though. You get the belt or the switch, right? So, but at least YouTube giving me the feature to put somebody in timeout for who's acting up, But, however, I don't get much of that from y'all, I think y'all pretty cool. Y'all pretty cool. So, I just want to give a market update today. Well, not even today. The markets ain't even open. I don't even know why I'm saying that. I haven't uploaded a video in a little while since I think it was one of my last interviews, or actually I did one on the banks and how I'm earning interest on my money, and just kind of the position I've been taking for a while is, stacking more cash, being prepared for some drawdowns in the equity markets. We have seen some huge rises in the some of the tech stocks, such as Nvidia went up multiples. You had a lot of rallies, which I knew some rallies were coming, and I was able to profit some of it from some from the rally. I wish I would have held some of my call options on the SPY, which is the S&P ETF. I had bought a call option about a week ago. I'll call in a put just to hedge, just in case. I ended up taking some profits on it. I think it was about $200 or something. And then I had the call option for June 16th. And so I had ample amount of time to wait until the debt ceiling was resolved and that the bill would be signed. So as I looked throughout this week, S&P chopped sideways. It looked like it was going to break out. As soon as the debt ceiling passed the Senate, the S&P, the SPY, the ETF, popped and went up about to about 428, I think, about 428. So my call option was for 420, and I bought this when the SPY was anywhere from, I think, 417. So, this call option ended up being worth over $1,000. I took some profits. You want to be okay with the profits you take, and you got to move on to the next trade. There's always going to be a next trade. But sometimes I beat myself up whenever I don't maximize my gains because I was hedged the other way as well. So that's kind of some things that I've been playing. A few things, that I'm pretty much anticipating in terms of the debt ceiling is the debt ceiling was raised, and a lot of people don't know the ramifications of that. They don't know how that impacts liquidity, how that impacts the financial markets. So the Fed has been doing quantitative tightening, so they're selling debt off their balance sheet. They're reducing their balance sheet, while the Treasury has been spending money, a lot of money, because they have huge deficits and they have to continue funding, Social Security, military, all those different things. So the Treasury general account had got down to under 100 billion, which they are mandated to have at least half a trillion, so 500 billion. So that the debt ceiling was a major issue. Was okay, they need to get this raised because they have bills to pay, and they have less than 1 trillion, or less than 1 trillion. They had less than 100 billion in their account left, and so they had to get the debt ceiling raised so they can issue new treasuries in the market, and so they can raise the capital to be able to pay the bills, right? Now, what does this do for markets? What this does for markets is it reduces the liquidity that is in the financial system. How does that reduce liquidity? First, you have interest rates are higher, right? So people are paying higher amount of interest on their debts. So that means that people, corporations, even government, that sucks liquidity out of the system because you're paying money that you would have is going towards interest, right? The other thing is the Fed is selling debt off its balance sheet, quantitative tightening. So the Fed isn't adding to its balance sheet, so that is reducing liquidity as well. That's been offset by the Treasury spending money into the financial system. Now the Treasury has to raise money in order to get back to its 500 billion mandate. So what that does is they have to issue treasury bonds or treasury bills and bonds, right? So these treasuries are like 10-year, 20-year, all different types of years, right? And so let's say you go buy a 20-year treasury bill or something like that, bond or whatever. Then that locks your money away for 20 years. And the government's promising to pay you back after, at that 20-year mark. So that sucks liquidity out of the system. So when they go to raise money and people are buying treasuries, those treasuries aren't at maturity yet because they have a time frame for that. So that could be 1 year, 3 year. They have short-term treasuries too. But, the 10, 20 years, and the government may have to offer a higher interest rate on those treasuries as well because we are in a higher interest rate environment. So, those treasuries may have to pay 4 or 5% or something. So looking at this, we know that liquidity is going to be impacted because the government has to raise money. They have to sell treasuries to suck money out of the system and into so that they can raise their balance sheet, right? So that they can raise their accounts, get their accounts back up. So what does that mean for markets? What that means for markets is, when you have a liquidity crunch, when you have a liquidity shock, equities go down drastically. So, and this may take a few months to play out. I don't know exactly how it's going to play out, but I know that the current circumstances that liquidity is at a huge amount of risk because now you're going to have the Treasury and the Fed on the same page, pretty much. So the Fed's quantitative tightening, right? And the Treasury is going to be raising money. And what that does is that's going to suck more liquidity out of the system. And we're going to have a liquidity crunch. Same thing happened in, I think, 2020, March 2020. That was a big liquidity shock. So you can expect some big drawdowns in the financial markets coming up sometime this year, I think. So obviously, right now, we're in a bear market rally. Bear market rallies happen, right? I think that, this could probably last a little while, but, the Treasury has to start raising that capital and have to start selling those Treasury bills, and that's going to suck liquidity out of the system. And so I advise, if you're in the markets right now, which I am, I've been taking profits. I've sold some stocks to get cash. I've been paying down debts. I've been, building up my cash balances because I'm able to get 5% and wait on the sidelines for whatever shakes out. So that's what I'm doing now. That's how the debt ceiling is going to impact financial markets from my standpoint and just what I've researched. And so I wanted to give you all that information. So be sure to play the cards how you may, but I'm just giving the information here. We're not in an environment where liquidity is heavily flowing. The Fed is still tight on monetary policy. Some people are anticipating a pivot. Normally the Fed raises rates, pauses, and then pivots, right? And even in those scenarios, during previous recessionary periods, the Fed doesn't fully pivot until something is like really broken or something is really happening in the economy, such as a recession, right? And we haven't even really seen that. I mean, we've seen somewhat of it with the banking crisis, but we haven't seen like recession. I mean, we had a strong jobs number come out and everything. So they are still waiting on the lagging effects of their monetary policy to kick in, you know. And so they may do a hike this month. I'm not fully sure. I don't view it one way or the other. If they do a hike, then I know that I'm gonna get more percentage, more interest on my savings, right? But also the interest that you pay on your debts is gonna go up as well. So just play this wisely. I don't think we're out of the woods yet, you know, and I think that, you know, we could be in for some big shocks coming this year. So later this year in Q3, Q4. So be sure to stay tapped in with me. I will be sure to upload more. I know I've been telling y'all that. Appreciate y'all that have been, excuse me. I appreciate y'all that have been riding with me for a long time. I'm going to keep uploading videos, keep bringing some more interviews coming and everything, you know. So yeah, stay tuned. All right, y'all. Y'all take care. Have a blessed day.